Hello and welcome to the Print Uninterrupted. I am Bidisha, consulting editor for economics at the Print, and joining us today we have Saurabh Mukherjea. Saurabh doesn't really need an introduction. Thank you, Saurabh, for joining
My
us
pleasure.
once again. But just to give a brief idea, Saurabh is the founder and chief investment officer of Marcellus Investment Managers. He was educated at the London School of Economics, where he earned his master's in economics with a distinction in macro and micro. And in London, he co founded Clear Capital. Prior to setting up Marcellus, he was the CEO of Ambit Capital. He is a founding director of the Association of Portfolio Managers in India and continues to be part of multiple SEBI working papers whose role is to review and reform the rules governing portfolio management in India. Saurabh, welcome to the Print Uninterrupted.
Thank you so much, Vidisha. Thank you for having me back.
um, let's start with where things stand right away. You and Tej have written a wonderful piece, and I'll just get directly to the
Hmm.
piece, talking about the NSDL data. And the NSDL data shows that FIIs pulled roughly 1.66 lakh crore out of
Yeah.
Indian equities in all of 2025, and they've already pulled out even more than that, around 2.7 lakh crore in the first half
Hmm.
of 2026.
Yeah.
So foreign
Yeah.
ownership of Indian stocks is near a multi-year low. And Indian equities have had one of their weakest years of relative performance against emerging markets in quite a long time. And you have argued that scrapping capital gains tax on equities for foreign institutional investors could actually reverse this. It could lower India's borrowing costs, it could strengthen the rupee, it could boost growth without meaningfully hurting the exchequer. So I would love to hear your thoughts about it. If you could expand on this.
Sure. No, so I think thank you for a wonderful summary of the FII pullout. I mean, it's unfortunate set of circumstances, but this sort of FII pullout, Vidisha, has no precedence, right? I've lived in India now for the best part of 20 years. I've never seen this level of money being pulled out of what is seemingly a healthy economy, right? If there was an economic crisis in India, these numbers, the FI exit numbers would make sense, but there isn't an economic crisis in India. So these numbers are perturbing, and we in Marcellus actually manage money for some of the global capital allocators, pension funds, universities in the Western world. So in June 2026, Tej and I visited America, Canada, and UK, and we spoke to them. And their point was that look, India is the only large market in the world which taxes foreign money, right? And we did the fact check, and these global investors are right. No other country invites foreign capital and then slams a tax on them. So, for example, we in Marcellus sit in Mumbai, and through our offices in Gift City, Gujarat, we invest in America. But America does not charge capital gains tax to Marcellus's Indian money, right? And countries like UK, USA, France, Germany, Japan, Singapore, no major market taxes foreign money. And I think this is at the core of foreign investors' bone of contention. They're saying this doesn't make any sense. Why are you taxing us? Often the universities and pension funds and churches in the Western world, Vidisha, they don't pay tax in their own country. They have tax exemption. So bizarrely, they don't pay tax in their own country. They don't pay tax in any other country. Capital gains tax is what I'm referring to. They don't pay CGT in any other country or in their home country, but they pay CGT over here. I think that's contributing to significant extent to the enormity of foreign investor outflows we are seeing, which in turn is exerting enormous pressure on the rupee. The rupee is down 10% in the last 12 months. In fact, it's more than 10% in the last 12 months. And it's very interesting. The RBI is trying its level best to stop the rupee's decline. The RBI has launched FCNR schemes. The RBI is using up precious foreign exchange to defend the rupee, and yet the rupee keeps going down. Every intervention to save the rupee seems to lead to limited relief, short-term relief, and 2 3 weeks later, again the currency slide downwards begins. So the point Tej and I are making in the article that we wrote for the print is we think we're at a juncture in time that getting rid of equity capital gains on FIIs would make a lot of sense. Not just because the FIIs want it scrapped, right? That's the least of it, perhaps. There's three reasons we are citing in the piece that we wrote for the print. Three reasons why equity CGT on foreign investors should be scrapped. Firstly, in June 2026, the government scrapped capital gains tax on foreign bond investors, right? The government also scrapped withholding taxes on foreign bond investors. I stress again, this was done for foreign bond investors. For domestic bond investors, CGT stays in place, but the impact was immediate. Within weeks of the government scrapping taxes on foreign bond investors, the best part of 40, 50,000 crores of foreign money flowed into our bond market. That led to a reduction in the 10-year Government of India bond yield of around 0.2%, right? So the natural experiment has been done. The government scrapped CGT for foreign bond investors, and the benefits were felt immediately. Right. The second reason is FII CGT. FII CGT earns the government of India around 15,000 crores per annum. Right. That's the tax take the exchequer gets. If FII CGT was scrapped, I think there's a high chance that the reduction in the 10-year Government of India bond yield won't be 0.2%, it'll be closer to 0.5%, right? It'll be orders of magnitude bigger because FII CGT flows are far, far bigger than FII bond flows, right? So 0.5% reduction in the Government of India's 10-year bond yield, Vidisha, is a 8,000 crore saving right off the bat. So 15,000 crores gone, I appreciate, from scrapping FII CGT, but you get a immediate benefit to the exchequer on reduced interest outgo of 8,000 crores, right? But the benefits actually are far bigger than that. Because if the rupee stabilizes at 95, 96, if the rupee stabilizes at 95, 96, Indian companies who are raising either debt or equity capital from global investors will get a better deal, right? At the moment, a debt or an equity investor is terrified about putting money to work in India because the currency is like a falling rock, right? You might have noticed that FDI flows into India FDI flows into India, which had been net FDI. So FDI comes in, FDI goes out. Net FDI flows, which had been so robust for so many years, the last 2 years, that's also dwindled and disappeared. And it's linked. If the currency keeps falling, even FDI gets scared and refuses to enter. So the third layer of benefits is we stabilize the currency by scrapping FII CGT. We scrap FII CGT. My reading is foreign money will come back to India with a vengeance. That stabilizes the currency. And the third layer of benefits I think we'll end up seeing is FDI, foreign direct investment. These are corporations abroad or private equity funds abroad. I think the chances will grow that they will put money back into India like they used to 4, 5, 6, 7 years ago. Right. So that's the threefold argument we are making. Obviously, the FIIs dislike this tax. It has no global precedence. But leaving aside the FII's dislike, I think there are three tangible domestic reasons for scrapping FII CGT and thus generating a macro win for India.
um, Very, very insightful. Kind of, you've given the breakdown, and I would like to get to, of course, a domestic retail investor paying 12.5% LTCG on Indian equities. But before that, and very rightly, you spoke about not just FIIs, but also, FDI, and in economics, as I like calling them, hot money and patient money, because
Yeah.
FDI is all about long-term investment, and both of them are imperative for the growth of the economy, and especially if the government is aiming for a Viksit Bharat 2047. Now, your article states that FIIs pulled 3 trillion out of Indian equities in 2025 and another, 3.4 trillion in the first half of 2026. And NSDL's own published data puts those figures about 1.66 trillion and 2.7 trillion respectively, meaningfully kind of lower by roughly 80% and 26%. Now, where does the difference come from? Like, are you including debt outflows gross rather than net figures, or a different reporting window altogether?
So we use the SEBI data, Vidisha. SEBI data, I presume, will consolidate across depositories. So NSDL, CDSL will be consolidated by SEBI. So the SEBI data is pretty easy to get, and we are using that. So on the SEBI data, 2025, 2025 saw around $30 billion of outflows. So assuming an exchange rate in the vicinity of 80 to the dollar in 2025, an average exchange rate of 80 to the dollar in 2025, a $30 billion of outflows would be 2.4 lakh crores. This year, the SEBI data suggests in the first 6 months of this year, around $31, $32 billion has left the country. This is FII monies leaving the country. Assuming this year an average exchange rate closer to, say, 91, 92, that's around 2.7, 2.8 lakh crores. So we're going by SEBI data, which I presume is NSDL, CDSL consolidated. And yeah, I'm hoping that the data itself is uncontroversial because it's coming from the securities market regulator.
uh, your 15,000 crore revenue cost estimate, it
Hmm.
rests on FIIs owning roughly 15% of market cap against total CGT collections of about 1 trillion a year. And now that 1 trillion figure
Hmm.
itself appears to trace back to a single, financial year 2023 data point of
Hmm. Hmm.
98,681 crore in LTCG alone, which doesn't even include STCG. Now that's a 3-year old, sort of partial number, and we all know there's always a lag in the data reporting and the data collection methods. So do you and Tej, have you come across lately, a more current, more complete estimate of what the actual revenue cost would look like now? Because I feel like it would have increased to a great extent, right, given
Yeah.
the changes
Yes
in
and
the
no. So you're
situation.
right. I mean, you're right. It's an old figure. So it's a FY23 figure. The reason it wouldn't have increased dramatically so is basically since October 24, Bidisha. October 24 is basically where we sort of topped out as a market. So over the last couple of years, the market really hasn't gone anywhere. And over the last couple of years, FII holdings in India have meaningfully diminished, right? So the market hasn't gone anywhere and FII holdings have diminished. That's why we felt the 15,000 crore LTCG contribution of FIIs will be a reasonably good proxy. Had the market bounded ahead and or FII holdings gone up, then the 15,000 crore cost to the exchequer of scrapping LTCG might have been unrealistic, but neither has happened, and therefore we believe the cost will be broadly there and thereabouts.
Interesting. So now, coming to this 12.5% LTCG on Indian equities, a domestic retail investor pays. And under your proposal, which I found quite interesting, a pension fund in New York pays zero on the exact same trade, in the exact same market. So you argue that foreign capital is mobile and domestic savings are captive. So differential treatment is justified. But how does that argument, survive contact with Indian politics? That is my question.
Right.
Isn't we are cutting
So,
taxes for foreign
sure.
funds while our own citizens keep paying? Isn't it close to an unsellable line for a finance minister, any finance minister?
Sure. Now, I think politicians can sell, they're very clever people. They can sell a lot of things. But let's step back and first look at the logic of the argument, right? So at the LSE, there was a course on fiscal economics. I'd taken only 6 months of it. I wish in retrospect I'd done the full year course. But in that 6 months, I'd been taught about the Laffer curve, right? So what the Laffer curve says is, if you keep taxing something excessively, the tax base itself will deplete, right? So the
Yeah.
simplest example of this is something which is highly inelastic. Let's take something which is highly inelastic. Let's take cigarettes. If you keep taxing cigarettes excessively, then what will happen is cigarettes will start being smuggled in from, say, Nepal or Bangladesh, and then the tax base, the number of cigarettes sold in India legally, will deplete, right? And therefore, even with cigarettes, where you could argue that the person smoking really doesn't really think about the taxes on cigarette smoking, right? Even on cigarettes, if you tax something as inelastic, as stable as cigarettes, if you tax it excessively, smuggling kicks in and your tax base depletes. Okay. Now let's apply that to the stock market. A domestic investor, he has no choice, right? He's basically in India. All he can choose between is equities and bonds, right? Fundamentally, assuming there are broadly two classes of investments. A domestic investor can either say, I'll put money in equities, I'll invest in equities, or I'll invest in bonds. On bonds, the effective capital gains tax rate is as it is 40%. So if you charge the domestic investor 12.5%, he's really not good. He's really not going to migrate from bonds, migrate away to bonds. He'll happily pay the 12.5 because relative to bonds, you're giving him a pretty attractive deal on CGT. Remember, our country does not have capital account convertibility, and hence the domestic investor really can't say, "I'll now run away to Dubai or Singapore or New York and invest there." So the domestic investor is captive. He has choices, but the main choice is the bond market, which is taxed even more heavily. By the way, I'm not sure that's a clever idea, but that's a separate discussion, right? So the domestic investor has nowhere to go, so he's captive. You tax him or her. The foreigner has the whole world in front of him. The foreigner has the whole world in front of him. And now you tell him that, come to our country, we want your capital. We are a capital starved country. We need your risk capital. And then when he rocks up, you say, now we will charge you 12.5% long-term capital gains tax. Oh, by the way, we didn't do it till 2018. From 2004 to 2018, we didn't do it. But we've since changed our minds. And not only have we changed our minds, we changed our minds twice. In 2018, we decided to charge you LTCGT for the first time at a rate of 10%. And then in 2024, we decided that we will now charge you at 12.5%. No other country does it. We didn't do it till 2018. And now, in our wisdom, we've done it twice in 6 years. 2018, we bought in a 10% LTCGT. 2024, we bought in 12.5. So naturally, the foreigner says, let me think about this. No other country charges as LTCGT. You want to do it? I'm not so sure I am that interested in investing here. When I have choices, I will take my money elsewhere. And does the foreigner have choices today? I think he does. So, for example, he can invest in a resurgent Japan. He can invest in East Asia and various technology plays. Even a country like Brazil, which never had a super hot stock market for the last 10, 15 years, courtesy the commodity boom, courtesy the growing demand for metals on the back of the AI boom. Even Brazil is cheaper and it has no CGT. And there's obviously the American market itself where many of these FIIs are tax exempt at home. So the FII is saying, I have choices and I will now run away, which means the tax base depletes. Not only does the tax base deplete, not only does the collection from FIIs start depleting, the Laffer curve, there are other knock-on effects for our country, such as a hammered currency, such as higher cost of fundraising abroad for Indian companies, both bonds and equities, such as reduced FDI coming into the country. Right, so that's the mental construct, right? Domestic investors, even in America, domestic investors pay CGT, but in America, we are a foreign investor into America. We don't pay CGT over there because the American government is saying, you, Marcellus, have lots of choices. You can invest in many different countries. I won't tax you. Please come and invest in my country. Right? So if the American government finds it appropriate, or the British government finds it appropriate, and the Japanese government finds it appropriate, I fail to understand why we in India believe it's a clever idea to tax foreigners coming into our country. This sort of thinking, by the way, it dates back to 93. I think 93 is when India allowed foreigners to come in. And as soon as decided they'll come in, we decided to start charging them a tax. Thankfully, in 2004, the then FM, I think it was Chidambaram. Mr. Chidambaram said, we will not tax foreigners LTCGT. And from 2004 to 18, foreigners did not pay LTCGT. As I said, in 2018, LTCGT came back at 10%. 2024, we doubled down on a bad idea by taking it to 12.5. And we're now at a stage where it looks utterly untenable. As you said, FII holdings in the Indian stock market are at record lows. They have only 15% of the market, rather than a figure closer to 20%. So the benefits of doing this are apparent on many different levels, not just theoretical. The practical benefit was evident when the FII capital gains tax on bond investors was scrapped. Immediately, you could see the benefit, both in terms of bond inflows and in terms of the government of India's 10-year bond deal dropping.
I'm so glad you kind of married the entire, situation that's happening, or the circumstance with, this curve by Arthur Laffer. And it's a very interesting bit. And thank you for mentioning about this particular concept, because it kind of helps us understand the ramifications, right? And it doesn't stop only at the markets, but it kind of spills over, not just the fiscal aspect, but also the monetary aspect. And thereby, we have an expanding trade deficit, we have an expanding current account deficit. So there are impacts, adverse
And
impacts,
if you
and
don't
there
mind, I'll come in on that expanding current account deficit, please, as well. What's happening is, for the first time since 91, Bidisha, AI is hitting our IT services exports, right? So our IT services exports have brought in foreign exchange of around $350 billion a year, right? Might be a little bit more, but just to keep it in ballpark, $350 billion of foreign exchange has come in, because we've taken Indian IT services companies, have taken recently graduated engineers who get paid 3 lakhs a year, and effectively sold them to the Fortune 500 companies at a 25% markup, right? That $350 billion of foreign exchange has allowed me to buy the laptop with which I'm doing this podcast with you, allowed me to buy the mic, my earphones, and so on and so forth, right? Now, courtesy AI, these IT services exports are going to diminish. We're already seeing the process. Last couple of years, the IT services exports have barely grown in dollar terms, and my reckoning is we will soon see the IT services exports number going south. So therefore, the mainstay of our current account deficit being broadly tolerable. Our current account deficit was in the vicinity of 1.5% of GDP, tolerable number. The mainstay of that was the IT services exports. That would allow us to buy the other things which make life comfortable and nice and worth living in India. As that goes away, I think the current account deficit will widen. It's already happening. We can see it in the balance of payments data. The current account deficit is widening. I think this will be a structural story. If the current account deficit is going to widen structurally, to stabilize the rupee, we need further foreign capital inflows, right? If the current account deficit will go south,
Yeah.
widens, we need capital inflows. If we're going to get those capital inflows, we can't be taxing that capital. So we also have to be pragmatic and realize that the macroeconomic circumstances today are very different from what they were in 2018 when our government decided to impose 10% long-term capital gains tax on foreign investors.
A very important point you spoke about the IT services exports, because that kind of explains, why we saw in the data in the January to March quarter there was a current account surplus, but after that we slowly started moving towards a deficit, because in the Jan to March quarter, if you see, highly this IT services exports and also Indians who are living abroad sending in a lot of money, but that kind of went downhill because now we are seeing the current account deficit number widen and widen even further. So thanks for giving clarity in this particular area. Now you also point to the June 2026 ordinance on FAR bonds, as a proof of
Hmm.
concept, and you argue that the equity case is stronger because equity carries no repayment obligation, but FAR bond buyers are large yielding chasing institutional treasuries, they with in fact a narrow predictable reaction function, and equity allocators, they weigh growth, they weigh currency risk, they weigh valuation altogether. So is it safe, in your opinion, to assume a tax elasticity result from the debt market transfers cleanly to equities?
I think had the Indian market been at the fag end of a massive bull run, or had the sorts of stocks that FII likes. FIIs tend to like large caps and sort of conservatively run large cap companies with good governance and clean accounts. Had those stocks been overvalued and had been at the fag end of a bull run, then I would admit that you had a point that bond investors are more stable reaction function. Equity investors are more volatile. But I think we're having this discussion, thankfully, Vidisha, after a 3-4 year period in which the kind of stocks that FIs like to invest have been thrashed black and blue. So just step back and let me layer this in two levels. India itself, the Indian stock market has had a epic level of underperformance. India's underperformance to MSCI EM is its highest in 30 years, right? So over the last 2 years, India's underperformance to MSCI EM is its highest in 30 years. So the Indian stock market itself seems to be at a place where valuations are not rich, right? Forward PE multiples, in fact, forward PE multiples for the Indian market are back to where they were in 2014 when the NDA came to power. So that's the first level. The market itself has had a thrashing. Within the market, the kind of stocks that FIIs like large cap, blue chip, quality names have had a further thrashing, right? So quality is at its cheapest in 15, 16 years. So you got a two-tier discount. So we went back in time. Tej and I went back in time, Bidisha, and we looked at two different things. We looked at junctures in which the rupee had been thrashed against the dollar, and we also looked at junctures where the Indian market had underperformed emerging markets. And then we said, let's do the overlap of the two. So let's look for instances where the rupee has lost enormous ground to the dollar, and alongside that, the Indian market has underperformed the dollar. And we found five such instances in this century, right? Five episodes where over the last 25, 26 years, the rupee has been thrashed and the Indian market has been thrashed. And interestingly, Vidisha, we found in the subsequent year, in the subsequent year, India outperforms emerging markets in dollar terms, right? And I think that's the most compelling argument. That's the most compelling reason for believing that from a valuations perspective, the FIIs are long overdue a return in India. right? From a valuation perspective, from both from a currency valuation and from a stock market valuation perspective, the odds are reasonably high that FIIs will come back. If we relent on, if the exchequer relents on this equity CGT, equity LT CGT, if the exchequer relents on this, I think the odds are very high that we will see punchy foreign inflows back into the Indian stock market.
Um, right. So, my last question to you would be from the fiscal credibility and timing point of view. You waive away the 4.3% fiscal deficit target as an objection that underestimates the broader macroeconomic response. But India's fiscal credibility with rating agencies has been hard won. Isn't there a real risk that even a well-reasoned tax cut gets read by S&P or Moody's as fiscal slippage, especially, without offsetting measures, but, making this kind of a much harder sell to the North Bloc than your article allows for?
Sure. So look, I mean, there's always ways and means to rebalance the budget. So let's come back. 15,000 crores, $1.5 billion. That's a modest sum of money in the context of a country where the government's borrowing requirement, just to put this number in context, 15,000 crores is what the FII piece is. The government's borrowing requirement in the year to March 26 is 17 lakh crores. So in the context of 17 lakh crores of the central government's borrowing, 15,000 crores, $1.5 billion is a manageable amount. Given that general elections are in 2029, given that in this fiscal there is no big assembly election either. The UP is in March, April 2027. So in this fiscal, there's no big assembly election either. And the general election itself is 3 years away. Given that the government seems to be in a politically strong position, I think spending cuts to the tune of 15,000 crores, spending cuts to that tune as a countervailing reduction should be doable. And highlight further that a 0.5%, just a 0.5% reduction in the 10-year bond yield will itself lead to an 8,000 crore reduction in the interest outlay. So net impact is arguably around 8,000 crores. 8,000 crores, less than $1 billion, less than $1 billion of spending cuts should be very doable. The fiscal cost actually is very manageable, and the fiscal story to the rating agencies can be spun quite neatly by saying, by making the currency more stable, we will reduce India's risk premium in both global equity and bond markets. Right? By making the currency more stable, we will reduce India's risk premium in both equity and bond markets, and thus there's grounds for saying that India's rating should not be affected by this. We're playing for something bigger. We're playing to stabilize the currency. We're playing to bring not just foreign FII investors, your hot money investors back into the market. We're also playing to convince the stable, the patient investors to come back into the market. And finally, we are playing for long-term fiscal sanity, because we seem to have done something here over the last 6-7 years, which has no global precedence, no global equal.
I did say that this is the last question, but your insights kind of pushed me to ask just one more
Yeah.
hypothetical question. Saurabh, if the government does nothing on equity CGT for the next 2 years, let's say, what
Hmm.
does India's capital account actually then look like by then? And if you had to bet, does this happen in the next 12 months? How do you see the picture?
Lovely question. Very provocative question. I think without bringing foreign equity investors back in, we will still have a positive on the capital account, but it'll be a small positive, right? Just to set this in the context of history, historically, we've had a CAD, current account deficit, of around 1.5%,
Yeah.
a capital account surplus of around 1.5%, and the two have thus balanced the balance of payments, right? The current account deficit potentially stays 1.5, perhaps goes towards 2 as the IT revenues shrink. To bring in CAD of 2% of GDP, we're looking at $70 billion. I find it hard to see how we will bring in $70 billion on the capital account without giving an olive branch to FIIs. Right? Out of that 70 billion, obviously, it's not all that 70 billion will be FII, roughly half and half FDI, half FII. If the FII doesn't come, I fail to understand why the FDI will turn up. Right? So the CAD looks clear to me at somewhere around if you are lucky, 50 billion, current account deficit of 50 billion. If you're unlucky, pushing 70, 80 billion. Uh, uh, what's not clear to me is what is the compelling story on the capital account. And if there isn't a compelling story in the capital account, then the RBI's foreign exchange reserves will get depleted uh, uh, to the tune of 70, $80 billion a year. By the way, that's where I think we broadly are at the moment. I think the RBI's capital, the foreign exchange reserves are being depleted. The RBI is being able to sort of shore that up by showing gold mark to market and not marking to market the short positions in the dollar, I suspect. But I think the foreign exchange position is fairly tricky. And the arguments, therefore, for making this FII tax cut now rather than when the situation becomes more dire is greater. Just to give you a sense of why I think the foreign exchange position is so tricky, leaving aside our maths on the RBI's forex, what the RBI announced last month was remarkable. The RBI said Indian banks should go abroad, raise foreign currency deposits, and raise external commercial borrowing bonds. And whatever foreign exchange losses emanate from this, the RBI said we will bear that. I have never seen the RBI do that before. I spoke to friends across the world, and one of them mentioned Argentina has done something like this in the past, and that's not a flattering comparison. We don't want to be doing things that Argentina has done. So I think that was a bit of a leading indicator that the foreign exchange situation is taxing. This taxing is vexing the RBI, and hence they came up with this policy that encouraging banks to go abroad and saying we will take the rupee depreciation hit. By the way, I'm not so sure this is the brightest idea going, because the FCNR policy initiatives have barely led to a couple of billion coming in via bank deposits. So we're urging the banks, we're encouraging the banks to go abroad, raise dollar deposits at 6.5%. And that's leading to modest inflows. In the meantime, the numbers we're discussing for FIIs are running at 50, 60, $70 billion a year of outflows. So I think we're making policy responses which are incremental when something which is relatively straightforward, which is something which is anomalous relative to the global context, is begging to be corrected.
Saurabh, this was a very, very insightful conversation, I
My
must
pleasure.
say. Thank you so much, first for the piece, and then now breaking down, every single facet of this area, because it's imperative for, even in layman's term, to understand what's exactly going on, so we can make our decisions, or the government can make the decisions accordingly in the long term. Really looking forward to more such pieces from you, and having more such conversations. Thank you so much for taking
Thank you,
out the time.
Vidisha.
Thank you to all who have been watching the Print Uninterrupted. Thank you.